Welcome to This Explainer. Today we're diving into the 10 absolute essential rules of personal finance. Look, if you've ever felt like managing your money requires a PhD in math, trust me, you are not alone. We're going to take some incredibly powerful, time-tested concepts and distill them into an everyday financial blueprint that you can actually use right now to take total control of your financial future.
To make these rules really stick, we're going to build a mental house across 5 logical stages. First, the foundation. Second, the guardrails. Third, the growth engine. Fourth, the end game. And finally, number 5, the reality check.
All right, let's jump right into stage 1. Part 1. The foundation, earning and building assets. You literally cannot build a secure financial house without understanding the tools and materials you're working with.
In your 20s and 30s, you absolutely have to hustle and focus heavily on active income. Trading your time for a paycheck from a job or a business. But, and this is crucial, your ultimate goal is financial freedom. And you get there by building passive income. Passive income is what buys your time back. It's the money that just keeps flowing in, whether you're sitting at a desk, traveling the world, or literally fast asleep.
Now, a lot of people think they can just stash their cash in a basic savings account. Well, relying purely on a savings account is actually a massive mistake. Why? Because of inflation. It's the steady increase in the price of everyday things which secretly decreases the future value of your idle money. Think about what a bag of chips costs today compared to 10 years ago, right? If you just leave a big pile of cash sitting around, its real-world purchasing power is literally evaporating.
So, to fight off inflation, you've got to prioritize buying assets over liabilities. A liability is just something that drains your wealth. It loses value the second you buy it, like an expensive gadget or a brand new luxury car. An asset, on the other hand, puts money back into your pocket. We're talking physical things like real estate or on-paper things like mutual funds. Plain and simple, the wealthy get wealthy by accumulating assets.
Okay, foundation poured. Let's move to part 2. The guardrails. Budgeting, emergencies, and debt. This is where we stop guessing and start applying concrete mathematical rules to our everyday spending.
Rule number 1 here is the invest first approach. You've got to flip that totally flawed spend first, invest whatever is left later mindset. It just doesn't work. Instead, set up your investments to automatically deduct right after your paycheck hits. If you get paid on the 5th, your investment should sweep out on the 6th. If you wait until the end of the month, you are going to find a way to spend it for sure.
And that routes perfectly into the famous 50-30-20 budgeting rule. The golden rule here is that exactly 20% of your take-home pay must go straight into savings and investments every single month. No excuses. The rest is super simple. 50% for your absolute survival needs like rent, groceries, and bills, and then 30% is for your wants. You can spend it guilt-free on dining out, vacations, shopping, whatever. It's the perfect balance of enjoying life right now while still securing your future.
Next up, the 6-buy emergency fund rule, often called the 666 rule. You need exactly 6 times your monthly expenses sitting in an auto-sweep savings account. This is not investment money, okay? This is your easily accessible safety net. Using an auto-sweep account gives you the flexibility of a savings account, but with slightly better interest returns to help fend off inflation just a bit, all while keeping the cash totally liquid.
Now, when it comes to taking on debt, you absolutely must follow the 40% EMI rule. This means your total monthly loan payment should never, ever exceed 40% of your monthly salary. Whether it's a mortgage, a car loan, or personal debt, if more than 40% of your take-home pay is going straight to the bank, you are completely suffocating your ability to build wealth.
Let's shift gears and talk about protection. Protecting your family is paramount, right? But people constantly guess at how much life insurance they actually need. Forget mixing insurance with investment schemes, you just want pure term protection. And there is a very specific mathematical formula you need to know.
It's the 20x rule. You need a term life insurance policy that is exactly 20 times your annual income. So if you make $100,000 a year, you need $2 million in coverage. It sounds like a lot,
But this ensures that if the worst happens, your dependents can invest that massive payout, live entirely off the interest, and never even have to touch the principal amount.
Guardrails are up? Let's build the roof with Part 3, the Growth Engine Investment Strategies. We've protected what we have, now let's multiply it.
Think of the money in your bank like a naturally growing tree. It'll grow a tiny bit on its own, sure. But investments? Investments are the fertilizer. Savings accounts keep your money alive, but you need that modern financial fertilizer to actually multiply your wealth and outpace inflation.
So how fast does that fertilizer work? Well, enter the Rule of 72. This is an awesome little mental math trick. Just divide the number 72 by your expected interest rate, and boom, you instantly know how many years it'll take for your money to double. If you have an investment yielding 10%, 72 divided by 10 is 7.2, so it'll take roughly 7.2 years for your cash to double. It's a neat little shortcut that'll make you look like a financial genius at parties.
But you also need to balance your risk, and for that, we use the 100 minus age rule for asset allocation. It's super simple. If you're 30 years old without crazy heavy liabilities, subtract 30 from 100. That gives you 70. So you put 70% of your portfolio into high-growth equity, like stocks or mutual funds. The remaining 30% goes into safer, more stable assets like debt or gold. As you age, the math naturally shifts your portfolio to be more conservative right as you approach retirement.
To keep all this organized, follow the 3x3x3 investment plan. This forces financial discipline from the ground up. Before you even think about chasing high returns, you lock down your 3 essentials: term insurance, health insurance, and an emergency fund. Then your 3 must-haves: debt repayment, a solid retirement plan, and something stable like sovereign gold bonds. Only then do you go after your 3 high-growth investments: stocks, mutual funds, and real estate. You don't buy stocks if you don't have health insurance, right? That's the rule.
With the growth engine roaring, we finally look toward the horizon. Part 4. The end game. Retirement planning. When does the hustle actually end?
Everyone dreams of early financial freedom. I mean, who doesn't? But how do you know exactly when you can safely hang it up and stop working without running out of cash? Well, retirement isn't an age, it's a number. Let's look at the math.
Is called the 25X rule. You are officially ready to retire at a standard age, like 60, when your liquid savings equal 25 times your annual expenses. We're assuming a moderate interest rate payout here. If you have that 25X corpus saved up, the interest alone should cover your yearly living expenses. You basically never even have to touch the principal.
However, if you're planning to retire early, say in your 40s, that 25X rule just won't survive inflation. You're realistically going to need to bump that multiplier up to 33, 40, or even 50 times your annual expenses to sustain yourself. Because if you retire at 40, you might need that money to last another 40 or 50 years. You have to account for the massive rise in the cost of living over those extra decades. And that brings us to our final stage. Part 5, the reality check, individual customization. Everything we've discussed is incredibly powerful, but it requires a touch of reality. We really have to confront the most important rule of all. Generalized math has its limits. There's a great saying for this. Just because a pineapple is healthy doesn't mean someone allergic to it should eat it. The exact same logic applies to personal finance. These rules we just went through are fantastic, proven blueprints. But what works universally might not perfectly fit your specific life situation, your debts, or your risk tolerance. If you're drowning in medical debt, well, maybe that 100 minus age rule is a bit too risky for you right now. Treat these as guidelines, not absolute gospel. So take these tools, sit down with an advisor if you need one, and ask yourself, how are you going to customize this knowledge to unlock your very own financial freedom? You've got the blueprint, you know the math, and you know the pitfalls. The only question left is, when are you going to start building?